Hello, savvy savers and tax-slaying titans. Today we're diving into the exhilarating world of tax reduction. Picture this, your hard-earned money working smarter, not harder, to lighten your tax load. We're about to journey through a landscape of 15 strategic investments, each with the power to reduce your taxes immediately. From 401k plans to energy tax credits, we're laying out the map to your fiscal freedom. So, buckle up and strap in as we embark on this thrilling tax-saving journey. Starting off strong with investment number 1, the 401k or employer-sponsored retirement plans. These are not just your average savings accounts, they are tax-favored accounts, a sort of like a magic money-growing tree, if you will. When you contribute to a traditional 401k plan, your contributions are typically tax-deductible. What does this mean? In simple terms, it means that the money you put into your 401k reduces your taxable income for that year. So you're essentially saving for your future and reducing your tax bill at the same time. Quite the financial two-for-one deal, wouldn't you say? So if your employer offers a 401k plan, it's a no-brainer to take advantage of it. Moving on to investment number 2, traditional individual retirement accounts or IRAs. These financial tools are a bit like a magic box. You put your money in, and not only does it grow over time, but it also provides you with some immediate tax savings. How, you ask? Well, contributions to traditional IRAs are often tax-deductible. This means that the money you put into your IRA could reduce your taxable income for the year. But remember, with great power comes great responsibility. There are income limits and eligibility criteria to consider. So, make sure you check these before deciding to contribute. All in all, IRAs are a fantastic way to save for retirement while also saving on your taxes. Next up at number 3, we have health savings accounts or HSAs. These accounts are a triple threat when it comes to tax savings. First, any contributions you make are tax-deductible. This means you can lower your taxable income just by setting money aside for health costs. But the benefits don't stop there. The money in your HSA grows tax-free over time, just like a good investment should. And when it's time to pay for qualified medical expenses, you can make withdrawals without paying a dime in taxes. Now that's what we call a win-win-win situation. Before we move on, are you enjoying this video? Don't forget to hit that subscribe button and ring the notification bell so you don't miss any of our future content. At number 4, we have flexible spending accounts or FSAs. These are special accounts where you contribute money on a pre-tax basis. This means the money you put into an FSA isn't counted as income, reducing your taxable income immediately. Quite the magic trick, isn't it? But the magic doesn't stop there. The money in your FSA can be used to pay for qualified medical expenses or dependent care expenses. So, not only are you reducing your taxable income, you're also setting aside funds to take care of your health or your loved ones. It's like a financial wellness plan wrapped up in a tax-saving package. FSAs, reducing your tax liability while taking care of your health, now that's a win-win situation. Coming in at number 5, we have municipal bonds. Now these aren't your average bonds. Municipal bonds are a bit like the superheroes of the investment world, swooping in to save you from the villain of taxation. Here's how they work. When you invest in municipal bonds, the interest income you receive is often exempt from federal income tax. Yes, you heard it right, exempt. But the magic doesn't stop there. If the bonds are issued by your state of residence, they may also be exempt from state and local taxes. So you're not only earning income, but you're also keeping more of it in your pocket. Talk about a win-win. Municipal bonds, a tax-free income source that's as solid as a rock. At number 6, we have low-income housing tax credits or LIHTCs. Now what's this all about? Well, it's an opportunity to make an impact while also enjoying some tax benefits. You see, when you invest in low-income housing projects through LIHTCs, you're directly supporting communities that need it most. But here's the kicker, this noble act doesn't go unnoticed by Uncle Sam. In return for your investment, you receive tax credits. And these aren't just any credits, they are dollar-for-dollar reductions in your tax liability. That's right, not a deduction from your taxable income, but a straight-up reduction in your taxes. Now isn't that neat? Investing in LIHTCs? A good deed that also reduces your taxes. Coming in hot at number 7, we have energy tax credits. Now these are not just for big corporations. Even as an individual you can benefit from them. How, you ask? By investing in energy-efficient improvements for your home or business. Think solar panels, energy-efficient appliances, and the like. These investments could qualify you for tax credits which directly reduce your tax bill. It's a win-win situation. You're not only contributing to a greener planet, but you're also saving money on your taxes. Now that's what I call a smart investment. If you're enjoying this content, feel free to hit that like button, it helps a lot. At number 8, we have small business investments. Now, we're not talking about buying the corner store and hoping for the best. We're talking about savvy investments in small businesses through qualified programs. Programs like Qualified Small Business Stock or QSBS and Opportunity Zone funds. These not only help small businesses grow and contribute to local economies, but they can also offer significant tax benefits to you, the investor. For instance, with QSBS, you could potentially exclude up to 100% of your capital gains from taxes. Similarly, Opportunity Zone funds allow deferral of capital gains taxes. It's a win-win situation. You're supporting small businesses and managing your taxes effectively. Small business investments helping the economy while helping your tax situation. At number 9, we have education savings accounts, a prime example of how investing in the future can yield benefits in the present. Education savings accounts like the 529 plans or Coverdell education savings accounts are fueled by after-tax dollars. But here's the catch. The earnings on these contributions grow absolutely tax-free, and it gets better. When it's time to withdraw for qualified expenses, think tuition, books, room and board, these withdrawals are also tax-free. So, you're not only saving for a solid education but also saving on taxes simultaneously. That's akin to killing 2 birds with 1 stone, isn't it? Education savings accounts, preparing for the future while saving in the present. Moving on to another essential strategy for optimizing your taxes, let's discuss tax loss harvesting. While this isn't an investment in the traditional sense, it's a crucial tactic to consider when managing your portfolio. Tax loss harvesting involves selling investments that have declined in value. Why would you do that? Well, this strategy allows you to offset capital gains from other investments, effectively reducing your overall tax liability. This loss can be used to balance out any capital gains you've made, essentially lowering the amount of tax you owe. This can provide immediate tax benefits, particularly for those in higher tax brackets. It's a smart way to turn a negative into a positive, financially speaking. Next up, we're going to talk about another smart tax strategy: investing in retirement annuities. Retirement annuities, which can be either fixed or variable, offer a unique benefit to investors: tax-deferred growth. What does this mean? It means that the money you invest in these annuities can grow without being taxed until you start withdrawing the funds, usually during retirement. This means you can reduce your current tax burden and potentially have more money growing in the account over time. Fixed annuities offer a guaranteed income, while variable annuities allow for potential growth based on market performance. However, like all investment strategies, annuities come with certain risks and fees. It's crucial to thoroughly understand these products and consult with a financial advisor before making an investment. Remember, the goal is to optimize your tax situation while also ensuring a secure financial future. Let's continue to explore more tax-saving strategies. Moving on, let's delve into another intriguing tax-saving strategy: investing in qualified opportunity zones or QOZs. Now, what exactly are these QOZs? They are economically distressed communities where new investments under certain conditions may be eligible for preferential tax treatment. The key here is to invest your capital gains in these zones. This can provide tax deferral and potential tax reductions on capital gains if held for a certain period. Here's how it works. When you sell an investment and realize a capital gain, you can invest that gain into a qualified opportunity fund within 180 days. The tax on the gain can then be deferred until the investment in the QOZ is sold, or until December 31st, 2026, whichever comes first. If you hold the investment for at least 5 years, there's a 10% exclusion of the deferred gain. If held for at least 7 years, that exclusion increases to 15%. And if you hold the investment in the opportunity fund for at least 10 years, you can potentially exclude additional capital gains from taxation. However, investing in QOZs isn't without risk. These investments are often in distressed areas and may not provide the return you're expecting. Up next, we'll explore more strategies to help optimize your tax situation. Next on our list is a unique and environmentally conscious way to potentially save on taxes: investment in conservation easements. Now, you might be wondering, what are conservation easements? They are legal agreements that limit the use of land in order to protect its conservation values. Landowners who donate a conservation easement to a land trust or government entity can potentially receive a tax deduction. This is based on the reduced market value of the land due to the easement. Here's how it works. Let's say you own a piece of land that has significant environmental, historical, or cultural value. You can donate the development rights of that land to a land trust or government entity, preserving its natural state for future generations. In return, you may be eligible for a tax deduction based on the difference between the land's value before and after the easement. Keep in mind, though, that not all conservation easements will qualify for a tax deduction. The easement must serve a valid conservation purpose and the donation must be made to a qualified organization. Also, the deduction amount can't exceed a certain percentage of your adjusted gross income in a given year. This strategy is not just about tax savings, it's also about leaving a lasting legacy. By investing in conservation easements, you're helping to protect our planet's precious resources. From a planet-saving strategy, we now move to a philanthropic one. Donor-advised funds, or DAFs. A donor-advised fund is a charitable giving program that allows you to combine the most favorable tax benefits with the flexibility to easily support your favorite causes. Here's how it works. You donate cash, securities, or other assets to a DAF managed by a public charity and get an immediate tax deduction. The funds are then invested for tax-free growth. Over time, you can recommend grants, essentially directing the charity on how to distribute the funds to qualified charitable organizations. The beauty of DAFs is that you get the tax benefit right away, even if the actual distribution of the funds to your chosen charities happens over a longer time frame. Plus, there's no rush to decide which charities to support. You can take your time to carefully choose the causes you care about the most. But remember, once you've made a donation to a DAF, you can't get the money back. It's a final and irrevocable donation. From philanthropy, we now turn our attention to a more tangible asset: real estate. Real estate investments offer a multitude of tax benefits that can significantly reduce your taxable income. Here's how it works. First, there's depreciation deduction. This allows you to deduct a portion of the cost of the property over several years, offsetting some of the income generated by the property. Next, we have the mortgage interest deduction. If you have a mortgage on your property, the interest you pay on that loan can be deducted from your income. This can be a substantial deduction, especially in the early years of a mortgage when interest payments are higher. Finally, there's the property tax deduction. This allows you to deduct the property taxes you pay on your real estate investment. These three deductions combined can significantly reduce your taxable income, making real estate a potentially lucrative investment strategy. But remember, real estate is a hands-on investment that requires time, knowledge, and often additional capital to maintain the property. It's important to consider these factors and consult with a real estate professional or financial advisor before jumping in. And with that, we've covered a comprehensive range of 15 diverse investment strategies that can potentially reduce your tax burden immediately. We've journeyed through employer-sponsored retirement plans, health savings accounts, small business investments, and even philanthropic strategies like donor-advised funds. It's important to remember that these strategies are not one-size-fits-all. Each person's financial situation is unique, and what works for one may not work for the other. This is why seeking professional advice is crucial before making any financial decisions. We hope this video has given you a better understanding of the impact of tax reduction strategies and has sparked your interest to learn more. If you found this content valuable, don't forget to like, share, and subscribe to our channel for more insightful financial content. We encourage you to explore our other videos to broaden your financial knowledge. Engage with us in the comment section below and let us know which strategy you found most appealing or if there's a topic you'd like us to cover in the future. Until next time, remember, investing is not just about making money, it's also about preserving it. Happy saving, everyone.